Hi and welcome. So in this video we kick off our chapter 9 of the Microeconomics 1 module. So in this chapter and the next, we are going to derive the equilibrium position of firms. So we want to determine whether or not is it profitable for firms to produce, and if so, what quantities of the product the firm should supply at different prices of the product. So to do this, we have to consider demand conditions as well. So in other words, we have to consider both demand and supply. So make an assumption that firms aim to maximize profit. So in the previous chapter, chapter 8, we examined cost, but we still have to examine revenue in more detail. So total revenue from the production and sales of product is calculated by multiplying the quantity sold by the price of the product. But the price of the product, and therefore also revenue, depends on the structure of the market. So these are some of the concepts that we'll explore in this chapter. We are also going to introduce you to 4 standard forms of market structure. That is perfect competition, monopolistic competition, oligopoly, as well as a monopoly. So the behavior of a firm depends on the features of the market in which it sells its product, as well as the production cost. The major organizational features of a market are called structure of the market, or market structure, and these are the 4 that we are going to analyze here. So these features include a number of relative sizes of sellers and buyers, the degree of production differentiation, the availability of information, as well as the barriers to entry or exit the market. Although we discuss the 4 different market structures in the next 2 chapters, we might want to think of them in a sequence or systematic form as follows. So at one extreme is the perfect market competition here, while followed by a monopolistic competition, then oligopoly, and on the other extreme is monopoly. So all firms fit somewhere between the 2 extremes. So either on the maximum or on maximum competitiveness or zero competitiveness in the market. So as you can see, or rather as we move from perfect competition to monopoly, the degree of competition declines from maximum to 0. So this means that here at maximum, the degree of competition is very high, meaning that this market is very competitive, while this one, there is no competition at all. So what we're trying to emphasize is that all firms fit somewhere along this continuous sequence. So the key features of the 4 different types of market structures are summarized in this table here. So eight features or criteria are listed in the 4 columns. So these are the 4 columns, and along these 4 columns there we have 8 features that are listed. Most importantly, they are organized here in the first column, and the remaining 4 columns show the position of each market type in respect to each criterion. So perfect competition is discussed in this chapter and serves as a benchmark against which the other market structures, which are discussed in chapter 10, can be compared. So we now discuss each of the criteria briefly. And one thing to note is that this is only a preliminary overview. We'll discuss perfect competition later in chapter 10. So looking at the table, the first criterion is the number of firms, which varies between 1 and many. So you can see here it's 1 within the monopoly, and with the perfect competition is so many that no firm can influence the market prices. So the actual number of firms as such is not particularly significant. The most important question is the behavior of firms, in particular whether or not an individual firm can influence the price at which its product is sold. So perfect competitiveness, or rather perfect competitive firms, are all price takers, suggesting that they cannot influence the price of the product. But monopolistic and imperfectly competitive firms are price makers or price setters, meaning that they each have some influence on the price of the product. So as you can see, moving from perfect competition to monopoly here, you realize that with perfect competition, there are so many that no firm can influence the market price. While with monopolistic competition, there are so many that each firm thinks others will detect its action. While in oligopoly, there are few that each firm must consider the actions of the actions and reactions of other firms. And within the monopoly, it means that there's only one firm, and it is the influence. They are the only one who influence the price or set the price without any competition. The second criterion is the nature of the product. So the product may be homogeneous, meaning that it's identical or standardized, or heterogeneous, suggesting that it is different or non-standardized. So the distinction between homogeneous and heterogeneous product is not based on a technical difference between them. So how it happens is that consumers ultimately decide whether two products are identical or different. So two brands of the same product may be technically identical, but if they are different in the eyes of the buyers, the product is classified as heterogeneous or differentiated product. So the third criterion is entry or mobility, which refers to the ease or difficulty with which firms can either enter or exit the market. So entries vary from perfectly free to totally blocked, as you can see. So in the perfect competitive market, the entry is free. It's completely free, while in the monopolistic competition, it is free. And with oligopoly, it varies from free to restricted, and within the monopoly, it is completely blocked. The fourth factor is the information or the degree of knowledge. So this refers to the information about market conditions available to market participation. So perfect competition are assumed to possess full information or perfect knowledge of the market conditions, which implies that there is no uncertainty under perfect competition. So this assumption also applies in the case of monopoly. So under monopolistic competition and oligopoly, the firms have incomplete information, meaning that they operate under conditions of uncertainty. The fifth criteria is collusion. So collusion occurs when two or more sellers enter into an agreement with each other to limit competition between or amongst themselves. So collusion is basically when two firms make an arrangement and understanding so as to close other competitors from entering the market. So this is commonly seen in oligopoly or oligopolistic market. So the sixth factor is firms' control over the price of the product. So a perfectly competitive firm has no control over the price of the product, since in a perfect market, or rather perfectly competitive market, it entails of firms that are price takers, whereas other firms have a varying degree of control over the prices of the product, but it's never absolute control. So they are price makers and price setters in other firms, in other market structures like monopoly and oligopoly. The seven criteria looks at the demand curve for firms' production. So under perfect competition, individual firms, which are price takers, are faced with a horizontal or perfectly elastic demand curve for each product. at the level of a market price. So in contrast, other firms are all faced with downward sloping demand curves for their product, and therefore have some scope for making or setting their own prices. So the price elasticities of the demand for their products can vary quite significantly between those which have control of their prices. The last criterion, which is the long run economic profit, basically looks at the possibility of earning an economic profit in the long run. So as we move through this chapter and the next, we're going to see that perfectly competitive firms do not earn any economic profit in the long run, as you can see here. So, however, the monopolistic and oligopolistic firms may earn positive or a certain level of economic profit in the long run. So as we study competitive or market structures, you realize that this table is very useful, and you might want to refer back to it whenever you seem to forget a certain fact. All right, so there are two basic equilibrium conditions for profit maximization that all firms operating in any market structure must adhere to. So as you may remember, any firm operating in any market structure wants to maximize profit. So economic profit is the difference between revenue and cost, which basically includes normal profit. So to examine the behavior of firms, we therefore have to examine and combine the revenue and cost structure. So once these are known, two decisions have to be taken into consideration. So the first decision is that firms must first decide whether or not it is worth producing at all. So under certain conditions, it should not be, or rather, it wouldn't be in the firm's interest to produce. So the best interest would rather to shut down its operation. The second one is that if it is worth producing, so the firm must determine the level of production at that profit is maximized in a case where they decide that productivity is the way to go. So these decisions have to be taken in any firm. So we explore two rules for profit maximization that apply to all firms, irrespective of the market conditions under which the firm operates. So the first one is the shutdown rule. So the shutdown rule is basically that a firm should produce only if total revenue is equals to or greater than total average cost. So which includes normal profit. So this is often called the shutdown or close down rule. But it can also be called the startup rule because it does not just indicate when a firm should stop producing a product. It also indicates when it should start producing or not. So the shutdown rule can also be stated in terms of unit cost, in the sense that a firm should produce only if average cost, or rather average revenue, is equals to or greater than average variable cost. So in the long run, all costs are variables. So production should therefore take place in the long run only if total revenue is sufficient to cover all costs of production. The second one is the profit maximization rule or profit maximizing rule. So the second rule is that firms should produce that quantity of the product such that profit are maximized or losses are limited. So profit maximization can be explained in terms of total revenue and total cost, or in terms of marginal revenue and marginal cost. So since profit is the difference between revenue and cost, it is obvious that profits are maximized where the difference between total revenue and total cost are the greatest. However, it is usually more useful to express the profit maximization condition in terms of the revenue and cost per unit of production. The rule is that profit is maximized where marginal revenue is equals to marginal cost. And the summaries of the different conditions are outlined here. All right, so we'll end here for the first session of our chapter 9. and we'll continue from this point in the next video.